All right. Well, we really appreciate you coming and talking to the class. So, we don't have very many Aggies that are in kind of the hedge fund and even you kind of hedge fund and crypto space. So definitely kind of unique in terms of your experience and in terms of what you're doing. So, maybe just start out by talking to us about how you got there, kind of, what you did in school, jobs, just kind of your career path, and tell us a little bit of a story about your background.
Okay, yeah, for sure. And yeah, good to be with the Aggies. Haven't been up to Logan in a little while, but yeah. So I studied finance and economics at Utah State. Had Ryan as a professor not too long ago, actually. After school,
What year did you graduate?
I actually graduated in 2019.
2019. That's when it did seem like it was longer than that, but I guess with
Yeah.
COVID, right? We get kind of this weird sense of time nowadays. So
Yeah, so I actually was in school a lot longer than I should have been. I went to a JUCO, Colorado, played football for a couple of years, transferred up to Utah State. None of my credits transferred, so I basically had to restart. But that's kind of where my career, I guess you could call it, started in the finance world. I really heavily became involved in the markets, both traditional markets and crypto in 2015, 2016, and then obviously dove deep with professors. From there, I worked as a stockbroker right out of school, got my Series 7 in 63. Having prior experience and knowledge of the derivatives market and traditional markets really set me ahead of everyone else that I got hired on with at the time. From there, I transitioned to a trader and portfolio manager at a private asset management company. They had I guess they have a large portfolio of real estate, and they opened up a branch to invest in crypto, and they brought me on. And so I actually recently started a position as an analyst while I'm getting this fund going. So there wasn't a conflict of interest at that private fund I was at previously. But yeah, that's a little bit where I'm at.
So was that your first foray into crypto then? And did you have any experience in crypto before you joined them, or was that you were kind of learning as you went?
Yeah, so I started investing and trading in crypto, and back in 15, 16, there was a handful of exchanges. You could count them on one hand. I used the back end of crypto at the time. It was called GDAX, and that's really where it started for me. I'm not sure if any of the class here is familiar with crypto, but nowadays there's hundreds of exchanges. There's thousands and thousands of websites, Discord channels, Telegrams. There's so many things that it's progressed from. But early 2016, my oldest brother, he's a IT tech guy. He helped me set up a few mining rigs, and applied what I knew as far as fundamental and technical analysis, investing, macro investing, to the crypto space. And I was able to take profits, not quite at the exact peak in 2017. 15,000 Bitcoin price. The rest of the crypto market rose with it, and I had some pretty substantial gains, and from there I took big portion of that into a couple different brokerage accounts. Went in on a couple of big trades, uranium. Had a big position on Tesla, and cashed out, almost quadrupled my net worth in a few years. And I really wanted to learn the private the private markets, private fund world. And so I'm really grateful that I had the experience at, the previous fund to learn. It really comes down to who you know, and it's really important in finding a mentor. For a period of time, Ryan, he was a great mentor to me, and I'm sure a lot of other students. He has a super cool story. How he got into finance, I'll never forget. But it's a super exciting time to be, in the finance world, and you guys are lucky to have Ryan as a teacher.
Hey, so tell us about kind of with that fund, your previous position, like what the day-to-day, what was, in terms of trading cryptos and taking positions or doing analysis or coding. I mean, kind of give us an idea of what that looked like on a day-to-day basis.
Yeah, so in the crypto world, they're still building out a lot of tools. So some things take a lot more work than they need. But day to day, it varied so much. Some days I'd dive deep into white papers and protocols and work with one of the developers and go through some of these codes. And over the last several years, I've learned Python and implemented some VAR modeling techniques for the portfolio to measure risk. And but a lot of the research comes from in the crypto world. It comes from untraditional methods. When you look at if you have an account with E-Trade or TD, whoever it is, you can click on a company's page and it gives you an overview of what the company does, their financials, earnings, revenue, all that sort of stuff. And a lot of that stuff isn't available with crypto. There's websites like CoinGecko, CoinMarketCap, things like that, where they show some of those ratios, but it often takes dozens of clicks on other pages to really dive deep and develop an investment thesis. A lot of things related to trading. We'd look at hundreds of charts.
And maybe just walk us through like some of your positions, like what types of trades were you making, or what types of trades were you looking at in terms of the crypto world, and then kind of walk us through that implementation process. So you have your investment thesis, you're developing that, doing some of the research, I assume beta testing some of the code in terms of making sure it runs as expected, and then implementing it in kind of small and large scales.
Yeah, so from a trade standpoint, we'd look at the overall portfolio and we'd want to get exposure to various aspects within the space. There's infrastructure, there's smart contracts, there's different types of thematic coins that serve different purposes. From there, we'd look at competitors, what their competitive advantages, their inflation schedule, their vesting schedule of the tokens, revenue incentives and revenue models. And if there were things that we liked, we'd get in a position. We'd look at the portfolio overall and consider our position sizing, and then from there, looking at the charts to find entry and exit levels, on various different technical analysis metrics using Fibonacci. Extension levels, we're using logarithmic charts in crypto a lot of times because they're experiencing exponential growth and trends. There's so many indicators I could talk about that for a while, but so I'm probably need to go into that. But and then we're looking at and following macro events. What the Fed is doing is obviously important. monthly FOMC meetings. We keep an eye on, dollar interest rates. Geopolitical is probably another topic for another day. And then we keep an eye on, what some of the other leading funds are doing in the space. And it kind of goes back, takes us back to the beginning of the, investment cycle.
So in terms of the trades, algorithmic, were you guys doing much in terms of algorithms, or just basically coming up with ideas and then executing them by hand? And, either you doing the trading or submitting them to a trader? What was your guys' process?
Yeah, good question. So we didn't do a ton of algo trading. I did actually develop a indicator that helps solidify, the buy, sell, getting into positions. We were long short portfolio.
So like what, just let me step in there. So like how much long short, what's your ratio? So for those of you that those finance or aren't, a lot of the students here are freshmen and sophomores, so they haven't had some of the classes and don't know that's right. So long, you're taking a position that pays when the price goes up. Short, you're taking a position when the price goes down. So like, I mean, how extensive were your shorts, or what was kind of your ratio in terms of longs to shorts?
Well, the last, couple of years, we experienced a huge bull market. So, for the first, probably 14, 15 months we were there, the majority were long positions. When things started topping out, the Fed implemented, some of their tightening mechanisms. We looked into a lot of short positions. We didn't use a ton of leverage, maybe 2-3x at most. But from there, we were implementing what's called delta neutral, market neutral strategy. So there's a lot of different arbitrage trades that we were doing that helped us get returns, whether the market's going up or down. And then one of my colleagues, the other portfolio manager, his focus was on yield farming, where if you were to take your money to a bank, say in the 80s, you could put in what's called a CD, a certificate of deposit, and they pay you 14-15% a year, or whatever it is. Nowadays, you're not getting even close to that. They might be paying 1% now. I'm not sure with interest rates rising what they're paying now, but yield farming in the crypto world is basically a way for you to generate returns by providing liquidity to these different pools of crypto tokens. And by providing liquidity, there comes additional risks. So that's why you're earning return. That's the incentive there. So sorry, I
kind of cut you off. You were talking about the algo. So you said you don't do much in terms of the algo trading. You had some buy and sells. So like, how are you trading daily? You trading weekly? What's kind of the horizon for most of your trades?
Yeah, so we aren't a prop firm by any means. We don't do day trades really. Didn't do them there. I guess you can consider it swing trades, anywhere from a week to several months. But I mean, it just varies so much.
So depending on your analysis, so sometimes it'd be a shorter trade, sometimes it'd be a longer trade, but it wasn't like it had to be kind of everything overnight or everything, long term. You were just kind of picking out whatever made the most sense.
Right. Yeah. And maybe we can talk about this later too, but if any of the class is involved with crypto at all, they may have heard about Celsius, Three Arrows Capital, some of these big funds that had to file bankruptcy. These guys were using extreme leverage, and when, as Warren Buffett says, when the tide falls, you see who's swimming naked, and those guys were bit for it pretty hard. So
yeah. But what about just in terms of the risk of some of the coins, like, Tether and some of these other ones that have had issues in recent times? Have you guys been hit by any of that? I mean, obviously the downturn in just the markets generally has hit the cryptocurrency world, and maybe even a little bit more so than others. But did you have any exposure to some of those coins that were problematic down the road?
Good question. So we actually did have a position in Luna, Luna Terra, or Terra Luna, and earlier in I want to say January, maybe 1st of February, I built out a VAR model, value at risk, and I'm sure you guys will learn more about this as you progress in the finance world. But it spit out some results that were kind of eye-opening, and it basically told us to get out of the position. And then as we dug a little bit further, we were looking at really their protocol and their model. And it's interesting that they said that they were a stable coin when they really weren't, and we were lucky to avoid that one. But we weren't really involved with any of the other projects. We were super lucky, but that comes from our due diligence and our vetting process, and looking at these contract audits and management teams and things like that.
So how much of that is economic analysis, and how much of that is like technical analysis, where you're looking at the actual, like, the code, the structure of the coin, the structure of the crypto? I mean, obviously there's lots of different ways they do things, and the details, sometimes that the devil's in the details. So how much are you digging into kind of the technical, code side of it, and how much is it more based the economic side of it in terms of what it's being used for, and the analysis on that end?
We had a guy specifically, he's got his engineering degree in coding, so he would help us on that sense. We definitely looked at the protocol, but our focus, from the investment standpoint, was more from the macro environment. We were in a structural bull market, so we were kind of just monitoring liquidity throughout the market, and positioning overall.
Skill wise, like what do you feel has been the most helpful in terms of your career that you picked up at Utah State, or what do you feel like there's areas where you could have maybe been better at coming out? What would you have, doing it different, what would you kind of focus on a little bit more, or where do you feel like you had plenty of preparation?
Things I would have done differently at Utah State, I probably would have taken more advantage of networking opportunities. And Paul Filstead, he last time I checked, I think he's still head of the finance club.
Yeah, we've shuffled the clubs around a little bit, but yeah, Paul's still here, pointing students in the right direction as usual. So
good. Yeah. I would have taken advantage of the finance club. Probably would have foregone a couple of weekend activities, but when it comes down to it, looking back, I did grind. I took a few different internships, and before I really started trading with real money, a great place to start is with a paper account, is what they call it. It's fake money. So there's no risk, right? And it really gives you an opportunity to learn the ins and outs of placing a trade, different strategies. You can start learning about derivatives, options, futures is probably another discussion for another day. But yeah, I mean, you can't ever stop learning, even after school. I'm pursuing the CFA designation. There's so many certifications and things that you can learn in the finance world. And so I think just taking advantage of, the resources you have available to you, is super important. Do they still have a Bloomberg terminal up there?
Yep. We still got Bloomberg terminals. We've still got.
Yeah. So take advantage of that. I used it a ton when I was a broker right out of school, which, you know, gave me a leg up to some of the other guys I got on hired with. If you're having trouble, you know, landing an internship, you know, it's hard to get experience, right? Especially from an internship standpoint. A lot of them don't pay, and you know, you're working either full time and going to school full time, or, you know, variation. And so it's a big commitment, but gaining, you know, as much experience as you can, you know, requires sacrifice, but it'll pay off. Absolutely.
Good. Yeah, I do preach the word of internships to them, right? The more experience, the more you can set yourself apart, the more you can kind of hit the ground running once you get that job, and the more likely you are to get that dream job that you're looking for. In terms of kind of back to your trades a little bit, what were you guys trading? Were you trading in the spot market, in the actual coins, trading in derivatives markets, doing both? You know, arbitraging between the two? What was kind of the types of trades you guys were making?
Yeah, good question. So a little bit of everything: spot market and futures. You know, in crypto, they're called perpetual futures. You know, in normal traditional finance markets, futures contracts have a expiration date similar to options. In the crypto world, perpetual means there's no expiration. They never end. It just continues to roll over. But we trade in the spot market. Futures, we trade, you know, decentralized exchanges and different, you know, lending pools, a lot of derivatives. You know, we use a lot of, you know, options on different exchanges, you know, to gain further upside exposure and you know, protect the downside as well.
Did you ever run into, so this is just me, kind of a personal question more than anything, because I've tried to trade some of those things, and you're somewhat limited as a US citizen in terms of which exchanges. Some of the bigger exchanges are actually kind of off limits. Did you guys have to figure out workarounds, or did you just have to do with what was there? I mean, I just think there's just different exposure levels depending on where you're at in the world in terms of your actual location. Did you guys feel like that was a constraint? Was it not that big a deal? How did you guys view that type of scenario?
Yeah, good question. So we did run into that occasionally. Some exchanges that we really wanted to use, like Deribit, for example, you know, they don't provide access to US citizens. The way that you know, we got around that, we had which we don't, you know, I don't recommend this. It's not something I encourage. But
yeah, listen, you don't have to answer. I don't want to get you in trouble either, so don't answer anything that might get you in trouble. But I just was curious out of, you know, personal experience. Same thing. I would see contracts on different exchanges, and I would seek almost clear arbitrages. I'm like, these are the same contract trading at different prices. You know, why is it not kind of resolving itself in a quick manner? And I think some of it was just because of the friction in terms of the countries and the locations, that certain countries have certain restrictions and others don't, and you can't trade as easily across some of those borders.
Yeah, they by the time I was leaving, they had, you know, submitted some filings that would enable them to access more exchanges. You know, that's how, you know, we're setting up our funds. We have access to you know, international exchanges. But yeah, we had some workarounds to use some that otherwise we couldn't have. But you know,
so does that just mean setting up some type of offshore entity to then make some of those trades to get around that, or is there an easier way of doing that?
Yeah, there's definitely an easier way to do that. Yeah. So one of my coworkers, he had a brother or something living in Peru or somewhere in South America. And so, he basically set the account up for us, and we were using it that way.
Just ran it through him. Okay.
Yeah. But yeah, I mean, they're getting smart enough now where even if you're using a, VPN and you plug it into Switzerland or whatever, they still see that you're in the US, and they'll block that. So, but, there's a lot of regulation coming out that I think is going to be, positive for the space. There's a lot of, positive things going on behind the scenes right now. I think are going to be helping with that.
So where do you see things going? I mean, obviously it's been a little bit dark times in terms of cryptos, and they've had some falling markets generally, right? Rising interest rates and all of the chaos that's going on from a day-to-day basis. I mean, any insights you could give us in terms of the crypto world, or how are you thinking about some of these problems in the crypto space?
Yeah, so that's what gets me really excited about the digital asset industry. There was a lot of similar regulation talk in the late 90s when the internet was coming out, and people overlooked it, and the people that were able to allocate in the early years have seen the biggest gains. And the market cap of the industry got up to 3 trillion at one point in 2021. It's under 1 trillion now. It's obviously come down quite a bit, but regardless of how much it's come down, the amount of activity that's going on in the space has actually been increasing over time, which is a very positive sign for the space. On top of that, there's the amount of institutional money that's come into the space, whether it's VC, hedge funds, it's quintupled since 2017, which I think in one way or another it can help provide a floor to prices. But there's a lot of countries, Argentina, Venezuela, that have very, very high inflation there. And one of the biggest concerns or arguments of crypto or Bitcoin is that it was supposed to be an inflation hedge, and it wasn't. And Ryan actually put out a pretty cool research report on this last year. But
yeah, just as a side note, right? We found that there was some inflation protection with Bitcoin in it, and since then, right, that was pre-pandemic data, and since then we've seen much more inflation, and it doesn't look like it works as well. So, our paper, we haven't updated it yet, but there have been other papers that have come out that have said that it's maybe not quite as good as inflation hedge as we originally thought, and that's partly because we just had such low inflation for so long. So.
Yeah. The other side of that, though, from a rate standpoint, I get that side of the argument. From a currency debasement, though, it provided an excellent hedge. When the money supply grew, they pumped trillions in the economy. Bitcoin and crypto, were huge beneficiaries of that. Gold did well as well. Obviously, not nearly as good as crypto. It's when the Fed, flattened out, money supply quit growing, and have since been tightening. Crypto has obviously come down from that. But when you look at, Argentina, Venezuela, in their respective currencies, the Argentine peso, Bitcoin has held its value remarkably well. And a lot of people are, not holding those pesos anymore, and getting into Bitcoin to, preserve their purchasing power.
Interesting. Yeah. So a good time in terms of, you think it's, we could see still more tightening with the Fed. I mean, that would be the expectation, is that we'll see some more rate increases. How do you see that playing into the crypto world?
Yeah, so that's part of our approach. From a macro lens, as far as what the Fed's doing, in past hiking cycles and inflationary environments, they have risen, the terminal rate, Fed fund rate, to at least what CPI and or core inflation measures are. And obviously those are lagging, which doesn't help the case, but I think they will continue to tighten. Another positive sign, while traditional markets and everything else has been selling off, Bitcoin and other cryptos have held at a floor around 19, 20,000. I think if we get closer to 8, 9, 10% interest rates, I think that would potentially hurt the environment. But I don't think we can stay there long if we were to go there. And if prices continue to fall, it's just a bigger discount to get in and buy it, fire sale prices. So
interesting. In terms of like pay structure, so at your previous fund, when you were trading and doing the analysis and everything else, is it pretty incentive based, where kind of depending on your trades, or was it what just give us a feel for what that type of structure looks like in kind of a private market position?
Yeah, my previous position, I had a salary with performance-based bonuses and percentage on winning trades. So I was very incentivized to put in the time, the due diligence, the vetting, to have these trades pay off. Their structure is a little bit different than others, but I think it's pretty fair to say that being in a similar position at another firm would be pretty comparable.
So like, I mean, a typical year is a quarter of your salary coming from incentive, is 50%. I mean, what give us a feel for that.
Yeah, so that amount will vary from firm to firm, but mine there, it was 80% salary, 20% incentive, and actually in 2020, the commissions off the trades were almost double of what the salary was. So yeah, there's definitely opportunity, whether markets are up or down, but it pays off.
Yeah. Okay. Yeah, I just obviously different students have different risk tolerances towards that type of thing, right? Some looking for something more stable, some looking for, the extreme version where you're a broker or something and you only make money if you close a deal, or if you do something on that end. I mean, eat what you kill type of position. So this we're somewhere in between, but definite high upside because of the the incentive-based trading.
Yeah, and there are a lot of positions, whether it's trading, you really have I guess the opportunity to help structure that. But there's a lot of positions like research analysts, positions where you can be given a salary if you don't want to take that risk, which I totally understand. There's private placement agents, is what they're called. They basically are people who help companies raise capital. A lot of times, they will take a retainer fee, is what it's called. It's percentage up front, and then whatever they raise, they'll take a big percentage of that, and then a lot of times they'll want to integrate some sort of revenue generating fee for the life of the fund. There's a lot of there's so many different analyst type positions, whether it's private equity, real estate, crypto. that do offer salaries. So
Yeah, definitely kind of have it from both ends in the industry. Well, so we've kind of referenced it, right? You've kind of switched gears here, kind of doing your own thing now. Why don't you talk us through that? Like why make the jump now? What's what are you thinking about? What are you doing? Give us an idea of what that latest move looks like.
yeah. Do I have the ability to share my screen?
Yeah, you should.
I put together a few slides to share. There we go. Can you guys all see that?
Yep.
So just wanted to explain, the structure of a private fund, whether it's, private equity, hedge funds, crypto, VC, venture capital. They're all structured in the same way. What differentiates them is, their asset class that they're investing in, kind of the structure of raising capital, whether it's equity or debt. But here, the general partnership, GP, commonly known as, this is the management. So our company is an LLC. It's RFB Capital Partners, and the limited partnership is our RFB digital assets. That's basically the pool of what these where these investors are allocating their money, and the LLC, the general partnership, oversees that. And we put together it's called a PPM, private placement memorandum, LPA, limited partnership agreement. You can think of it as like the private fund Bible. You get to decide what goes in there, the terms of what you're investing in, pay, distribution structure, things like that. What's a little bit different about hedge funds, there's a prime broker involved. In traditional markets, you can think of JP Morgan, Goldman Sachs, and this is who you use to go through to place the majority of your trades. A lot of times, especially bigger hedge funds, they'll use what's called an executing broker, because if you were to trade yourself and buy 100 shares, there's enough liquidity to fill that trade order, just like that. But when you're trading, a block trade is 10,000 shares. When you're trading hundreds or thousands of blocks, executing broker will basically find a seller or buyer depending on what end of the trade that they're on. And then a lot of hedge funds will use leverage, and they will use a separate prime brokerage to hold collateral, or there's things like separately managed accounts, unified managed accounts, separate asset manager to hold that collateral in case things go south. As far as the different types of hedge funds, there's a lot out there. Really, if you can invest in an asset class, there's probably a hedge fund for it. But we're obviously focused on crypto. Later on the road, we plan on launching a commodity fund. I've been pretty heavily involved in the commodity space as well, but equities, fixed income, currencies. Forex market is one of the biggest markets out there. There's between 4 and 6 trillion traded every single day in that market. Distressed debt, this could be a private equity fund, hedge funds. If there's a business or a pool of businesses that are going under, or really struggling, they'll go in there, buy it, at a huge discount, get a new CEO in there, kind of flip things around and get, revenues going and sell it, at a premium later on. And then multi-strat strategy. There's a lot of firms that have this type of approach, and we actually are implementing multi-strategy approach into our crypto fund. But I'd say the styles, there's three really styles of investing. There's micro, macro, and activist. And from a micro standpoint, you're looking at things like candlestick trading, algorithms, mean reversion, kind of smaller, very narrow window style of investing. A macro is more of a holistic approach, looking at the economy, the economic engine globally of what's going on. This can include things like event-driven credit events. A hurricane could come into Florida, and you could short insurance companies, policies, trend following. There's a lot of things like that. And then activists, it's not as common today, but it still does happen quite a bit. Somebody or a fund or research analyst of a fund will create a bunch of content, whether it's positive or negative, about a company, and then they'll if they want a price of something to go up, they'll put out a really positive report. But before that, they will buy the asset, and then once they put out all this information, the price starts going up, and they profit from that way. So they're not as common anymore, mostly due to regulation. There's some issues with that, insider trading, front running type thing. But with that being said, private funds aren't they aren't exposed to the amount of regulation as traditional markets. And really, at the end of the day, that's why they're have the ability to invest in so many different things. As far as our approach, so I think I mentioned, we have a combined approach of a micro, macro, and we also have a long short strategy involved. We have market neutral strategies, so we're able to profit, regardless of what the market's doing. And then we're combining these strategies with Bitcoin mining, with a trading strategy to increase, returns on that. I wanted to show this chart because I think this is something that's overlooked in the investment world. If you were to draw down 10%, it takes 11% to recover, and large losses, hurt the portfolio, disproportionately. So if you were to lose, 50% of your account or trade or whatever, you need, 100% to recover. And with crypto being so volatile, people can get hurt pretty bad. And if they're not using risk management strategies, it can be a very difficult place to invest. With that being said, the volatility is what gives us, the huge upside in the crypto markets as well. But if you take a look at the chart on the right, the blue chart is just the regular S&P 500. You can see the huge drawdown in 08-09 from the GFC, Great Financial Crisis. And then in COVID, there's a few others prior to that. In the green chart, it is the same S&P 500 index, but it's excluding, these five or six drawdowns of 20% or more. And, the returns of this portfolio, quadruples. And so, we're also implementing a small portion of our portfolio to, risk management, and, we're taking advantage of what's called, convexity instruments, high convexity. And that's probably another discussion for another time. But huge payoffs if the price does come down, more so than traditional, derivatives such as an option. I'm sure you're familiar with this, Ryan, but things like variance swaps, we've partnered with a group that, that's their expertise is dealing with the exotic derivatives, OTC markets, over the counter markets, where you can't really find these types of products, anywhere else. So, but yeah, I mean, there's from a competitive standpoint, there's a lot of different funds out there in the crypto world. There's funds that just trade. There's funds that just mine Bitcoin. The ones that have just, been mining Bitcoin, they've done really well over the last several years, but with the price coming down, they're not nearly as profitable. And some, that got in the space at the top, they were buying these Bitcoin mining rigs, these machines, at a huge premium. Those premiums have, since come down to, a huge discount. They're probably 75% off right now. And we're incorporating, this mining strategy with these other trading strategies to give us a competitive advantage.
Fantastic. Hey, listen, really appreciate your time, your insights, the discussion. Anything else like words for students, things to think about, or last piece of advice that you'd give to students as they're thinking about different careers and different internships and majors?
Yeah, I think one of the biggest piece of advice I could give is never stop learning. The most valuable thing that you can invest in is yourself. These things put you ahead of your peers. And also, a lot of people fear change. So you need to embrace it. You need to get used to, change. It's we're coming at a, pretty interesting intersection of a lot of these new technologies coming out, biotech, AI, blockchain. There's a lot of change coming up. And so if you can embrace it, that's where all the magic happens, outside of your comfort zone, when you're trying new things. And it's okay to not know everything. There's a lot of people out there that are way smarter than me, like Ryan, for example. But that's okay if you don't know the answer. Having a thirst for knowledge is important. Enjoying what you are studying and learning about is important. And if you don't want to go the finance route, that's okay. I find, this industry exhilarating. There's a ton of money to be made, but, for me and my family, it's more about, the quality of life and doing something that, that I enjoy. So I think taking, in your first couple of years, you're taking a lot of generals. Try a few different areas of classes to really find out, what you like, and keep at it. Go Aggies.
Go Aggies. Fantastic. Hey, once again, thanks, Joel, for taking some time out and chatting with us. You okay if students reach out, connect with you on LinkedIn if they have questions or if they have anything else they want to follow up on?
Absolutely. And I can share this slide with you if you'd like.
Oh, look, you had more slides.
Yeah,
Sorry,
I wasn't sure how much time we had.
I didn't mean to cut you off. So
that's okay. But I can share this with you. Reach out to me on LinkedIn or email me, Joel at rfbdigitalassets.com. If I don't respond right away, don't get mad. I got a lot going on right now, but I'll get back to you as soon as I can. Just tell me, let me know you're in Ryan's class, and be happy to answer any questions.
Fantastic. Hey, thanks so much. Really do appreciate it. And best of luck. Keep in touch.
Okay, will do. Thanks for having me.